Hello, everyone, and thanks for joining us today for our newest installment of our Hummel Group webinar series regarding business planning. My name is Trent Blauch, and I'm a financial advisor here at Hummel Group. I'm joined today by Jordan Miller of Rea Associates. He's a CPA there, where he specializes in business and individual taxation. Our goal today is just to provide some informational pieces for business owners of basically any scale. If you're just getting started, this will be informative to how you can set up your business from a tax standpoint. To anybody maybe in a more seasoned position that is looking just for other tidbits on running your business efficiently from a tax standpoint and planning, and also introducing some investment options that can help you plan for the long term so that your business can successfully end and retirement can be achieved, and how you can also save along the way in an efficient manner from a tax standpoint as well. Go through the agenda here. So for the agenda, you can see here, we're going to get started here soon with Jordan. He's going to run through choice of entities, some banking options, accounting systems, who's some trusted advisors in your planning process can be, and who to rely on for proper guidance and advice as a business owner. Planning for taxes, how you can add employees and subcontractors efficiently. And then I'll handle some financial planning items regarding retirement planning, investments, and how you can be efficient there. So without further ado, I'm going to go ahead and turn this over to Jordan, where he's going to get his piece started on tax planning. So Jordan, go ahead and get you going here.
All right, can you hear me there, Trent?
Yes, you are good to go.
All right, hey, thank you, Trent, for having me, and looking forward to touching base on some of these items that you've kind of laid out there on the agenda. Yeah, appreciate the opportunity to share and represent our firm here. As Trent mentioned, this is kind of all general information. I highly recommend getting a specific advisor to help you through your specific situation. But hopefully you get something out of this, and if nothing else, some ideas for planning. So as far as getting started, these are some things to kind of consider before you jump into business, into a small business or an idea with a partner. The first step would be to just do some market research, and the best way to do that is actually work in the industry, or interview suppliers, maybe some complementary providers, even competitors, to get an idea of the industry you're getting into and the space you'll be operating in. Read industry publications, and if you can get a hand on some benchmark publications for pricing and cost information, and that can be specific to being a startup, or if you're jumping into a mature industry. So that would be step one. And then after you've kind of got a handle on the industry and the market locally, the next step would be to write a business plan. So you can kind of think of this as your roadmap for your new company. Oftentimes you'll need to present a business plan when you go to get bank or investor capital. So this is not like a standard form. This is something that will be unique to your business. But if you do need a template to start off of and kind of get the process started, the SBA, SBA.gov has some good templates to kind of give you a starting point. Speaking of financing, you'll have some startup costs with getting into business as a self-employed individual. So you'll need to decide on how to obtain capital. Do you want to use banks and pay interest, or do you want to use your own capital or investors and give ownership rights to those individuals that are helping you get started? Or do you use a mixture of both? That'll be something you'll need to decide when you get started and fronting those costs at the beginning. Some obvious things you'll need to decide on a name and location. What do you do business as? Where's your principal office? All of those things can have tax ramifications, so you'll want to choose where you're located carefully and what makes sense from a business standpoint. And then we get into things like, are you going to be a sole owner? And we'll talk about choice of entity here in a little bit. But are you going to have multiple owners? Does it make sense to bring in another person who can do something that you can't? That's usually the main reason to have a second owner. But yeah, does it make sense to bring someone else, or should you operate this on your own? And then kind of lastly, what licenses do I need to operate in this space? Some of the common ones, a vendor's license or a contractor's license, or if you're operating in an area of specialty, like a electrical contractor or something in the medical field, an attorney, a CPA, those all have specific licenses to their industry. So you'll need to know what you need to practice in that space. Okay, so I mentioned we jump into a little bit of choice of entity. This is a complex area, so I just highly recommend working with a professional and making this decision when you get to this point. But we'll cover kind of the most common, I guess, choices that you'll have. So we'll start with probably the simplest, which is a sole proprietorship. As mentioned, it's simple. It can only be one owner. That's hence the word sole. So you only have one owner in this choice. In general, you have no liability protection with this. You're just kind of operating as yourself. So you won't have any kind of legal liability protection with this form. And as far as tax filings, in general, you just have a separate schedule on your owner's personal tax return, on the owner's personal tax return. So generally that's going to be a Schedule C on your tax return. So that's sole proprietorship. The next one there is a partnership. So this happens obviously when you have more than one owner. The entity itself is a partnership, and it files its own tax return to report the profits and losses. And then each owner receives what we call a Schedule K1 to report his or her share of those profits. Now, the partnership itself in general doesn't pay tax. Rather, those shares of the profits flow through to the owner's personal tax returns. So that's kind of the distinction there, but you do have a separate filing for the partnership. With a partnership or entities electing to be taxed as a partnership, the owners cannot be on payroll. Instead, you receive what we call guaranteed payments for the work that you do for the company. So think of your salary for doing work for the partnership is going to come in the form of guaranteed payments. But you're not getting a W-2 at the end of the year. All that is reported on your Schedule K1. This is the default treatment for LLCs that have more than one member, in case you wondered. The third one there is a C corporation, and so we have two different kind of distinctions on a corporation. You have C corporation or S corporation. With a C corporation, this can be one owner or multiple owners. It, kind of like the partnership, files its own tax return, but differing from the partnership, it pays its own tax on that return. So it is not a pass-through entity. Rather, it pays all its tax and reports all its profits on one return. The tax rate for that, we'll get into tax rates a little bit later, but that's a flat 21% tax rate currently on the profits. And then if you pay owners out, if you distribute those profits to owners, the owners then pay tax on the dividends. So that's, if you ever hear the term double taxation, that's kind of what they're referring to, is the corporation is paying tax on its profits, and then the owners then pay tax on dividends of the money they take out of the corporation. So that's a C corporation. An S corporation is a little more similar to how the partnership worked, but it can be just one owner or multiple owners, and it also files its own tax return. But similar to the partnership, it's a pass-through entity, and so the owner reports the profits from the entity on his or her individual tax return. Something a little different from the partnership, though. An S corporation, the owner goes on payroll and receives a W-2 for its work done, for his or her work done in the company. And there's a potential for savings on self-employment tax with an S corporation because they're just going to pay the self-employment tax on their or the payroll taxes on their wages on the W-2. So that's kind of getting into a little bit of the weeds, but in general, those are kind of how those different entities work. Now, a common question we get is, that last bullet point, an LLC. An LLC really isn't an entity in the eyes of the IRS. Like, that's not a classification that you would file a specific LLC tax return, but rather you elect how you want to be treated when you're an LLC. So LLCs are very common these days when you're forming new entities, because they provide liability protection. But once you form your LLC, you have to decide, do you want to be treated as a partnership, a C corporation, an S corporation, or a single member LLC that gets reported similarly to the sole proprietorship. So all things that you would get into with your CPA or accountant when you're getting started here. Okay, so just a quick touch on some banking items. Probably the most common question we get is, do I need an EIN or an employer identification number? The answer to that is generally yes, if you have employees, or if you operate as a corporation or a partnership, or if you have to file any kind of employment tax or excise tax returns, you're going to need an EIN. There's a whole website on the IRS website, irs.gov, that kind of walks through the different situations when you might need or when you can use a social security number instead. But in general, it's probably best to get an EIN if you're in doubt here. An important note kind of with that is a separation of personal and business. We always advise a good record keeping process with keeping your business separate from your personal life. This is beneficial for a couple different reasons. First off, it helps you know how your business is doing. You can clearly distinguish what's business and what is personal, and know if your business is profitable. But also, if you have any kind of LLC or corporation, this is what maintains your liability protection. So if you are intermixing business and personal on a regular basis, that could what the attorneys call pierce your corporate veil and basically undo any liability protection that you have in the LLC or corporation. So as a best practice, we say, if you're one of those entities, you either should be on payroll to get paid for your services, or take draws, that basically writing a check from the business to your personal account rather than paying for personal expenses out of the business to best maintain those liability protections. Also, they're kind of establishing accounts. Those are the type of accounts that if you're operating a business, you might need an EIN to get those at a bank. So, okay, we'll touch briefly here on accounting systems. This is another question we get. Kind of what systems right for me and my business. We see it all from the simplest, being paper ledgers, especially in our area with the Amish. We see the green sheets still and spreadsheets. If you can make that work for you, great. We see probably 90% or more of our clients are using QuickBooks, which is great for a lot of different businesses. But it all depends on what you need. Do you need invoicing or inventory tracking? Do you need more of a customer relationship management system? All those factor into which one is right for you. I've tried to list kind of the most common that we see, from simplest to most complex, but that's a general list of what we see most often. Okay, so I think Trent kind of alluded to this earlier in the presentation, but I would say from my section, if there's one thing that you take away from this, this would probably be the slide to take home with you. And I kind of call this your personal board of directors when you're getting started as a business. So these are the 5 individuals that I'd say you need to find a person that you trust and can advise you on these different areas. First up being an attorney. You know, we've talked about establishing different kinds of legal entities. They can obviously help with that. They can help with buy-sell agreements, and then just ongoing legal consulting and advice. So find an attorney you trust. Same goes for a banker, and you might have a couple of each of these, but I think it's important to have one that you really trust and you can have as a go-to. But yeah, a banker is an important relationship for your capital needs. You know, think a line of credit or equipment loans, and then just cash management in general. Third up would be, you know, your CPA. This is obviously self-serving here, but I think it's important to have a CPA or an accounting professional that can help you with proper record keeping, how to record, you know, unique transactions that aren't your everyday, help with tax planning and preparation of your tax filings. And then the last 2, I think Trent is familiar with your insurance agent. You know, help make sure you have coverage for unforeseen events, and know what coverages you need for your specific industry. And then, you know, Trent's area of expertise with investment advising and, you know, retirement planning, coordinating your tax deductions with your CPA, and then investment advice for your stage of life. Okay, as far as taxes, and again, this is just very, very general, high level, how taxes work for the different types of entities we've covered. C corporations, we said, you know, that's a flat rate of 21% on your profit. So what's left after all the money you bring in, less all your expenses, whatever's left, that is what you're taxed at, is 21%. Whereas the pass-through entities, so those are your single member LLCs, the sole proprietorships, partnerships, and S corps. Those can be anywhere from 0 to the 37% at the federal level, at least. So it all depends on how much of that income is flowing through to the owner, and it's combined with other entities that are flowing through to the owner, and then other income on your return. So it varies pretty widely, but you can see that it goes from 0 to 37%. You also have with your personal return, you know, self-employment tax, which is when you're self-employed, you pay 15.3%. So this is, you know, think of Social Security and Medicare. This is the tax to pay in for that as a self-employed individual. When you're employed by a company, they take your half out of your check, your net check. When you're self-employed, there's no one to do that. So you're paying self-employment tax through your estimated payments and truing up with your tax return at the end of the year. At the state level, you have, you know, state income tax is kind of similar to that pass-through entity, 0 to 37. At the state level, it's 0 to 4.797%. And then another one that I just thought I'd mention is the commercial activity tax. Some people aren't aware that this tax is out there, but This is an Ohio tax on businesses. So it's a gross receipts tax. So it's not on the profit, but actually the top line revenue. So if you're an entity that has 150,000 or more annually in taxable receipts, you might be subject to commercial activities tax. So just wanted to throw that out there as something to kind of keep on your radar. Okay, so finishing up here on taxes, I mentioned estimated tax payments in the slide before, where you don't have someone withholding your income tax and self-employment tax for you. So in order to pay in timely throughout the year, you probably need to be making estimated tax payments, and a CPA or a tax preparer can help you with making sure you're paying in enough. The due dates there are on the screen. So first quarter is due in April 15th, and so on, second quarter, third quarter, and fourth quarter. Another question we get is how do I pay myself when I'm self-employed? Well, it kind of depends on which entity choice you've selected from that previous slide. You would put yourself on payroll if you are an S Corp or a C corporation. If you are a sole proprietorship or a single member LLC, you just write checks to yourself in the form of draws. And then if you are a partnership, we already discussed, you're getting paid as guaranteed payments, which is also a check from the business to yourself personally. So that's another common question we get is how do I pay myself when I'm self-employed? All right, these are my last couple slides. Just wanted to, I'm not going to get into a lot of these details, but just wanted to put it out there on your radar as far as when you get to the point where you're adding employees versus hiring what we call a subcontractor, who's not your employee, but you're hiring them to do some work for you. These are the two classifications in the eyes of the IRS, and it's very important that you classify these correctly. So it's a common issue that the IRS looks at. In general, subcontractor treatment is easier for the business. You don't have to file quarterly reports, withhold taxes, pay benefits, all of that stuff. But it's common that you actually meet the threshold for the person being an employee instead of a subcontractor. So you want to make sure you get this right. If you go to the next slide, these are kind of the factors that the IRS considers as far as, is it an employee or is it a subcontractor? So in general, the more control you have over a party doing work for you, the more likely it is that they are an employee versus a subcontractor. So I've got a link there to an IRS.gov article on how to make that distinction, and it's another thing that your accountant or your attorney can help you out with making the decision as far as which classification it meets.
Awesome. Hey, thanks a lot, Jordan. Really appreciate the input there and running through that side of the presentation for us all and keeping everybody informed on that. So thanks again.
Thanks, Trent.
All right, so we'll go ahead and get to the financial planning portion of the presentation here. So these are just kind of some overall topics that I'm going to hit on from what I specialize in as a financial advisor here at Hummel Group, to help on the financial side as a business owner and individual as you plan through these different items moving forward. So life insurance, it's an important piece as a business owner and an individual. Whether you're not a business owner or not, it's a very important piece of the financial planning picture. Individual retirement accounts, cash management alternatives, and employer-sponsored plan options are the bullet point items that we'll touch on here at this part of the presentation. So life insurance, from a business owner standpoint, you're going to have options such as a buy-sell agreement where you can look at a cross-purchase or an entity purchase. A cross-purchase plan depends on each business owner and how they're going to buy a life insurance policy on each of the other owners. So basically how it works is if an owner dies, the remaining owners use the payout from the life insurance policy to buy the deceased owner's share of the business. So, if you have a partnership, buying policies on each other to protect your business interests is very important to continuing that succession in the lifeblood of the business if an unfortunate event happens. For somebody that may be a sole proprietor or an individual business owner, stating a life policy, having that in place to protect yourself if you're the main income earner in the family. You want to protect that income. The value of your business, even without partners, is also very crucial in that planning process. The other option being an entity purchase plan. Each employee or owner enters into an agreement with a business to sell their interest in the business. As part of the agreement, the business buys life insurance policies on the lives of each owner. The business will pay the premiums for the policy, and it exists as the owner and beneficiary of the policy. So it's more of like a corporate-owned type of arrangement. If that key person dies unexpectedly or at some point in the course of the business relationship, the company would absorb that life insurance payout to compensate for their position in the business. An individual life policy, like we touched on, is also going to provide protection. Again, more stated on an individual basis, to where if you have a spouse, children, trust, a charity you may want to leave it to, you can name all those people as a beneficiary. I touched on key person life insurance. This is often used for when there's a key person. Maybe it's an owner or a high-producing salesperson within the organization, to where if an unexpected event happened and they passed away, the business is protecting themselves from the cost that it may incur and the income generation potential that is lost from the passing of that person helps kind of make them whole for the brief time it takes to find a replacement. Individual retirement accounts, or IRAs, those are a tax-efficient savings vehicle for any individual, not just business owners, of course, but they are a very efficient way to get money put aside that can be beneficial from a tax standpoint, either in today's dollars or dollars down the road. So touching first on a traditional IRA, an investment account with a $6,000 contribution limit if you're under 50, or $7,000 if you're over 50. It's a full tax deduction if you're not eligible for any other employer-sponsored plan. It can be made in addition to a SEP IRA or simple IRA contributions. The money's accessible at any point, except if you do take funds out before age 59 and a half, there is a 10% early withdrawal penalty plus taxes would be due on those funds. Open architecture investment solutions, meaning you can do basically any type of investment, stocks, bonds, mutual funds, depending on your risk category and what you're trying to achieve with those funds. A traditional IRA is something that's going to give you a full tax deduction up front, followed by basically just deferring those taxes to a later time down the road when you withdraw the funds, hopefully after age 59 and a half, and entering retirement to help supplement any other Social Security or income you may have at that point. The other option from an IRA standpoint is a Roth IRA. Same contribution limits, $6,000 and $7,000 if you're under 50 or over 50 there. These are not tax deductible contributions. However, the long-term benefit of having this type of account would be the tax-free withdrawal options of your contributions and earnings after age 59 and a half. So paying the taxes today for a benefit of tax-free income in retirement would be the goal of opening a Roth IRA. So neither one is a sure-all fix for every individual. Everybody's tax situation is different. Both provide great benefits for long-term retirement income. There's no age limit cutoff for contributions. You can make contributions in your 70s, after the required minimum distribution ages. You are not required to take an RMD from this, which is when you reach age 72. Those monies can stay within the Roth IRA for as long as you live. And also an open architecture system would be the same as well, where you can pick and choose the investments as you wish, or depending on your goals for the account. A SEP IRA is a type of traditional IRA contribution that kind of opens the door towards a potential higher contribution limit for self-employed individuals. The contribution limits for that would be 25% of compensation up to a max of $57,000, whichever is lower. So it can definitely open the door, like I mentioned, to higher contribution limits, greater tax savings up front, and helping to get potentially higher chunks of money put aside and invested for the long-term success of yourself and your retirement income future. Whatever proportion you put in for yourself, if you have employees, it must be distributed the same across the board so that everybody is treated equally from the same percentage of their salary, no discrimination or anything like that across levels of employment. There's no Roth option on this, so it's a tax deductible option only. Like I mentioned, it's considered a traditional IRA, so an RMD is required at age 72. Early withdrawal penalties if under 59 and a half. Open architecture on the investment options there as well. This is also goes back to Jordan's point on your business entity setup. That's going to help us as financial advisors determine if this could be a good option for you based upon how your business is set up. Simple IRAs. Basically what these are small business retirement plans, generally set up for 100 employees or less within your business. There cannot be any other type of employer retirement plan in place. There's no filing requirement for the employer, so there's a little less work on the reporting and filing standpoint with IRS and things like that. The employer is required to contribute each year in one of two ways to any participant's account. There could be a flat 2% contribution made regardless of what the employee is putting in. So hypothetically, an employee could put $0 of their paycheck in and still get a 2% contribution made by their employer. The more frequently used option is a 3-and-3 contribution and matching equation that employers put in place. So basically what it is any contributions up to 3% are matched 100% by the employer. So an employee puts in 3%, they're getting matched by their employer at 3%. They can put more than that in if they wish. The employer is only responsible for the 3% matching. $13,500 is the max contribution an individual can put in. If you're under age 50, you can put an additional $3,000 in if you're over 50. So another way that you can add a nice benefit to your business if you have employees makes it attractive for earning and retaining employees. Creating a benefit culture is always going to keep people interested and incentivized to stay with your company. There are low cost, low maintenance retirement plan options for small businesses. So we work with a lot of businesses that implement these that want to provide something extra in terms of compensation and benefits package for their employees. One also thing to mention would be that the employee is always 100% vested in those funds. meaning all of the funds within that account are theirs as soon as they hit the account. There's no waiting period or anything along those lines, that if they want to have access to the funds, that restricts them from doing so. It's always good to check with an accountant or financial advisor on what that may look like, but from a vesting standpoint, that is always 100% vested. And lastly, we have an option of a 401k plan. This would be a more robust style plan for maybe your larger businesses or somebody that wants to offer greater flexibility in contributions, perhaps a greater investment option menu. Can be broader and have access to institutional share classes, and utilize multiple mutual fund companies to offer additional diversification for the employees and investors within that plan. Employees can contribute more to this plan than under any other IRA plan themselves, potentially at $19,500, $26,000 if you're over age 50. Roth and traditional deferral options are available. And like I mentioned, investment options are typically broader, and you can access institutional share classes, which are more fee efficient for the plan and individual investors themselves. Same early withdrawal penalties and RMD options apply. It offers a more custom plan design and flexibility, and is more, like I said, more suited towards a business with a higher number of employees. There are some additional administrative costs and arrangements that need to be taken into account. Also, some additional testing to make sure there's no discrimination in favor of highly compensated employees, which can add some different dynamics to the plan. So just some additional things to be aware of. Here at Hummel Group, we have many resources in the retirement plan design arena, Rea Associates being one that we partner with in cases here. So we have great resources to help you navigate through that if that is an option that you are looking to implement for your business. So something to keep in mind as you move forward. That concludes what I have here for everybody today. Again, I want to thank Jordan for joining us and his team at Rea Associates for coordinating with us here to make this happen. It's people like Jordan and his team at Rea Associates that bring value to what we offer at Hummel Group by having great relationships with these outside firms that have unique abilities and specialty services to round out your financial planning picture. So it's one thing we pride ourselves on here at Hummel Group is having access to those specialty services, as well as different niche businesses that we work with. We work with a variety of different individuals and businesses from a financial planning standpoint, and we look forward to those future relationships going forward. If questions arise, our contact information is here. My information here again, email addresses for myself and Jordan. I also have a schedule link for myself and our website, Hummel Financial Advisors. If there are any questions that an individual may have, I'd be more than happy to field those. And if it's anything we need to direct to Jordan, we will gladly do so as well. So thank you all again for attending and tuning in today. It was a pleasure speaking with all of you, and I hope you all have a good rest of the week and stay safe. Thank you.